All right, let's talk about Assured Guaranty. You see their latest earnings headline, revenue down 23%. Ouch, right? But then the stock pops over 6%. So what gives? It's a total paradox, and that's exactly what we're going to decode today. We're going to figure out what Wall Street saw that everyone else missed. Let's get into it.
Okay, so here's the game plan. We'll start with that surprising quarter, then dive into the actual results versus what everyone was expecting. We'll listen to what management had to say, decode the market's reaction, and then I'll give you our outlook and even a trade idea to think about. Sound good? Let's go. All right, section 1, the surprising quarter. And believe me, this one was a real head-scratcher. It's one of those classic situations where the big, flashy headline tells you one thing, but the real story, well, that's something else entirely.
And this really is the million-dollar question, isn't it? How on earth does a 23% drop in revenue cause a stock to rally 6.5%? It just doesn't compute, right? Well, to figure this out, you have to do what the pros do. You've got to ignore that headline number and look a little deeper.
Okay, let's get beneath the surface. This is where we find out what was really going on. You know, the market is always forward-looking. It's not about what just happened. It's about what's going to happen. And tucked away in this report were all the clues investors needed to see a much, much brighter future.
Okay, so here it is, the big reveal. On the left, you see the headline number everyone freaked out about, GAAP revenue down 23%. But on the right, that's the real story. Forget revenue for a second and look at profit. Their adjusted earnings per share, they didn't just beat the estimates, they'd absolutely demolish them. We're talking a 70% beat. Now that is a number that gets Wall Street's attention, big time. And let me put this into perspective for you. The Wall Street consensus, what all the analysts were predicting, was around $1.50 per share. Assured Guaranty comes in and posts $2.57. I mean, that's not just a beat, it's a complete knockout. That's the moment the whole narrative flipped from, oh no, revenue is down, to, whoa, look at these profits. But wait, there's more. It wasn't just about the profit they just made. Look at this number, plus 44%. That's the growth in what they call PVP, or present value of new business production. Basically, it's a measure of how much profitable new business they're signing up. And seeing that jump 44%, that tells you the pipeline for future earnings isn't just growing, it's accelerating fast.
And if that wasn't enough, check this out. Their adjusted book value per share hit an all-time high. Now think of book value as the company's fundamental, rock-solid net worth on a per-share basis. For a financial company like this, it's one of the most important metrics. And hitting a record high, that's not some fuzzy projection, that's tangible proof that the company is creating real, measurable value for its shareholders. So we've seen these incredible numbers, but how did they do it? Let's dive into what management said on the earnings call, because, numbers like these don't just happen by accident. There's a strategy behind it. And the CEO, Dominic Frederico, he basically spelled it out for everyone. He said, we continue to build value for shareholders, and pointed right to these record high numbers for book value. The message is crystal clear. They're not just trying to grow the whole pie. They're obsessed with making each individual slice, each share, more valuable. That is music to an investor's ears. And check this out. They're executing this plan from a position of absolute dominance. They control nearly 2/3 of the insured U.S. municipal market. But here's the crazy part. They're so dominant and they are still gaining share. They went from 57% to 63% in a single year. That's not just being the market leader, that's lapping the competition. So how are they pulling this off? Well, it boils down to a few key moves. They're jumping on the right kinds of deals, especially in the municipal and secondary markets. They're also being really smart about the kinds of business they're writing, focusing on stuff that turns over faster. But honestly, the real kicker is this. They are returning a ton of cash to shareholders. We're talking $134 million in just one quarter through buybacks and dividends. And they just re-upped for another $100 million in buybacks. That's a huge lever they're pulling to drive that per-share value up. Okay, so we've got killer numbers and a smart strategy. So, did the market get it? Let's follow the money and decode exactly how investors reacted minute by minute. This timeline is just fascinating. So November 6th, after the market closes, that weak revenue number comes out and the stock actually dips a little. The algorithms probably sold it. But then, overnight, humans, analysts and portfolio managers, had time to read the full report and listen to the call. And by the time the market opened on the 7th,
Boom. The stock opens up almost 3% and just keeps climbing all day, finishing up 6.5%. That's the market figuring out the real story in real time.
And this wasn't just a small move on low volume. Look at this. The number of shares traded that day was nearly double the average. What does that tell you? It tells you the big money showed up. We're talking mutual funds, hedge funds. They saw the real story and started buying with both hands. This is a massive vote of confidence.
All right, so we've broken down the past. We understand the numbers, the strategy, and the market reaction. So now for the big question. Where do we go from here? Let's talk about the outlook for the next call.
Okay, when you add it all up, the business is firing on all cylinders. Management is being super smart with its capital, and they are laser focused on creating shareholder value. Our rating here at Talk Tickers is a firm outperform. I really believe that 6.5% pop was just the appetizer. The main course comes as the rest of the market catches on to this story. And why are we so confident? Well, a few big things. The market they play in, U.S. municipal bonds, is booming. Their newer ventures are growing like crazy, and those massive buybacks, they act like a safety net under the stock price. And hey, don't just take my word for it. The average analyst on the street has a price target somewhere north of $100. So yeah, there looks to be plenty of runway left.
Okay, last section. So based on everything we've talked about, let's play armchair hedge fund manager for a minute. How could you construct a trade around this thesis? Again, just an idea, not advice.
So you could think about a play we'll call the capital return arbitrage. It's a 3-step process. Step 1, you go long the shares. Why? Because you're capturing that huge discount to its book value, which is over $180. Step 2, to juice your returns and lower your cost, you sell covered calls against your stock. Think of it like getting paid to wait. You collect cash up front. And that leads to step 3, the thesis. You're betting the company's own buyback program creates a strong floor for the stock, so your downside is limited while you just sit back, collect that call premium, and wait for the market to wake up and re-rate this thing higher.
And, of course, the big disclaimer at the end. I have to say it, this is not financial advice. It's for informational and educational purposes only. You should always do your own homework and consult with a professional before making any investment moves. All right, that's all for this one.